Hello, this is Brandon Christy with Christy Capital Management with an educational economic update for September 2016. In this month's video, we'll discuss some of the major headlines that influenced markets in August and give you some insight into what they could mean for you as an investor. Please stay tuned at the end for a required disclosure statement. Markets rallied for much of August on better than expected earnings reports and some strong economic data. However, official statements showing that the Federal Reserve is moving closer to raising interest rates again gave some investors pause. With the bulk of corporate earnings season behind us, we have a pretty good picture of how U.S. companies performed in the second quarter. Looking at results from 483 S&P 500 members, we see that overall earnings are down 3.2% on revenues that are up by 0.1%. While lower profits aren't good, corporate managers did a good job of managing expectations. Over 72% of these companies beat their earnings estimates, and just over half beat their expected revenues. The stock market treated most of this news as a win since traders had been surprised by the results. The Federal Reserve was also the source of a lot of market activity last month. Minutes from the July meeting of the Open Market Committee showed that Fed economists were split on their opinion about the economy and interest rates. Fed hawks, those who want to raise interest rates soon, believe that the economy is strong enough to withstand higher rates as soon as September. Fed doves, the economists who favor a more cautious approach, aren't convinced that a rate hike needs to happen quickly. They think that low inflation and global concerns mean the Fed should wait and see. We and most Wall Street analysts don't believe that the Fed will raise rates in September. However, there's a reasonable chance that they might act in December. If the labor market continues to improve and economic growth looks solid, we could see higher rates before 2017. Speaking of economic growth, we got our second look at gross domestic product growth at the end of August. The first estimate, which showed growth of 1.2%, edged down to 1.1% in the second report. Why? Broadly, while consumer spending ramped up last quarter, business spending pulled back, leaving economic growth stuck in neutral. What that means is consumer spending, the largest factor in U.S. economic growth, kept the economy growing. Businesses took a look at their shrinking profits and closed up their wallets. Well, what can investors expect in the coming weeks? It's likely that we'll see more volatility and perhaps even a pullback as investors digest data ahead of the November election. The Federal Reserve votes on interest rates this month, and that will also add to the speculation. Well, that's it for this month's Educational Economic Update. As always, if you have any questions or concerns about what we've discussed, please give our office a call at the number below. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 866-331-7749. This is Brandon Christy with Christy Capital Management and your September Educational Economic Update.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision.